How do you see, what is the exit strategy then for Bitcoin for you?
There is no exit strategy. If you're a crypto investor and you run a venture capital fund and you want to make investments with high risk, high reward, and you want to study it and you want to take the risk, then you can trade in those things. But in my opinion, they're 100 times less lucrative over time and they're 100 times more risky. So it seems like it's a 10,000 to 1 difference. I wouldn't do it, but other people do it. And it's probably good for the industry because it markets the industry, right?
Right.
And they're venture capitalists. They have to do it. Like, I'm not going to, I'm not going to tell them not to do it. It's like, this is one risk tranche. This is a different risk tranche. If you're super smart and if you guess, will it be Binance Smart Coin or Ethereum, or maybe it's both, maybe you trade. But, when you get into that, you get this question of, well, when are you going to take money off the top? And when are you going to diversify? And are you going to be in it forever? I tend to think I would prefer to invest in things I can hold for a decade, if not 100 years. But there are plenty of people whose job is they're venture capitalists. And the venture capitalists are betting on things where they think there's a 90% probability it'll fail. But they think that they'll get 100x return if it hits. So it's a different thing, right? So I would say it depends on your portfolio of money. Like are you investing someone else's money, your own money? Are you a VC? Are you a private equity investor? Are you a saver converts their money into a strong currency? An investor manages a portfolio of risk. I buy some Apple, some Facebook, some Google. They've all got risk. A trader manages a portfolio of risk derivatives. I'm guessing, I've got options in Apple, and I think that Apple's going to beat on the next quarterly release.
Right.
It's not even a portfolio of risk over a decade. It's a portfolio of risk over 90 days. Or it's the second derivative of risk. I'm like shorting Apple options against Google options because I think the spread is coming in, and it's something you can do.
Right.
It's just a different thing, right? I'm arbitraging people's risk derivatives, and fine, knock yourself out if you're bored, if it's your profession. But another analogy is like a decade ago, if you bought Apple and Amazon and just held them, you probably would have made a lot of money. You would have made 10 to 20 extra money. Now, if I could go back 20 years or 10 years, would I give people advice about when to buy and sell Apple in the year 2012? Or how to trade Apple options against Amazon? Should you buy or sell Amazon in the year 2014? Can you remember off the top of your head whether you should have bought or sold Amazon in 2015 so you could buy it back cheaper in 2016, or did it? Yeah, by the way, if you had, Jeff Bezos was at war with Donald Trump before the election. And so what's the worst thing that could happen to Amazon? You would think that it would be Donald Trump getting elected, right?
Right.
But, if you had actually sold Amazon once you know that Donald Trump was getting elected, it would have been the most catastrophic decision in your life, because Amazon stock doubled in the first 12 months after Donald Trump was elected. You understand what I'm saying?
Right.
It's like you're a trader and you know the future, you'll probably still lose money. Because the best thing that ever happened to Jeff Bezos, Jeff Bezos, his greatest enemy got elected president. Jeff Bezos' stock went from like $800 to $3,200. Mm-hmm. Okay, Jeff Bezos got divorced. Is that bad? It should have been bad for Amazon. Didn't seem to be bad. It was good for them. Like all sorts of, it's hard to predict what might be good or what might be bad. You go back a decade, and if I told you, I think Facebook, Google, Apple, Amazon are good companies, what's your best strategy? Why would you ever, right? You wouldn't ever sell it. But this is better than that, because this is one city in cyberspace where 5 billion people are going to live there. You don't need the second city or the third. Right. Like whereas you can make the argument that, well, you need a Tokyo and a London and a Paris. But in cyberspace, people in Tokyo, London, and Paris and Manhattan are all putting their money in Bitcoin. So this is it's a global dominant, pure monetary energy network. So you don't need an exit strategy, right? Diversification is selling the winner to buy the losers. Right. like it's like an exit strategy from a country where the currency is collapsing. You're reinvesting back into a place that's weakening. So the right thing to do is the opposite. And what you should expect is an inversion of the entire financial order. As Bitcoin grows, you're going to see people sweep greater portions of their investable assets into Bitcoin, and the entire ecosystem will reorient where Bitcoin is the center of the universe. And at some point, Bitcoin becomes $100 trillion to $200 trillion of an asset, and everything else is a derivative of Bitcoin. It's basically synced to the Bitcoin standard.